Everyone, and welcome to the latest in our series of virtual client events. Thank you so much for joining us today. We appreciate there are many different calls on your time, and we feel immensely privileged for your continued support. Thanks to those of you who have responded to our recent client survey and have been kind enough to leave a review on Vouched For. The survey closes later this week, so there's still time to respond if you haven't done so already. This will be a great help to us for improving our service to you. As second lockdown approaches, rest assured that we're working remotely and it's very much business as usual. We've learned some lessons from the first lockdown and we are working on new ways to improve our client experience and the sense of the expert wealth community. Our aim with these client events is to give you access to great speakers who are leaders in their respective fields of expertise. There's no spin or agenda other than to inform and educate. With that in mind, we're already planning on running similar events in 2021. And whilst we have a few guests in mind already, we welcome any suggestions from you. So do drop me an email with names of people and/or topics you'd like to hear about, and we'll see what can be done. As always with our events, we welcome input and audience participation. So feel free to ask questions through the chat facility, which you'll find at the bottom of your screens. We'll get to those questions later on. And then in a week or so's time, we'll email out to all the clients a link to the recording, which will be on our website. So you'll be able to catch up on anything of particular relevance or indeed watch the whole session again at your leisure. Today's topic is that of so-called star fund managers. If you've ever read any of the financial pages in the weekend papers over the years, you would have been subject to endless column inches of noise. Faced with such an onslaught of noise, it's no wonder the investing public fall victim to the cult followings that come with the publicity of star fund managers. But history is littered with former so-called star managers who've subsequently fallen from grace for one reason or another. To name a few, we could pick on Peter Lynch of Fidelity, Anthony Bolton, also of Fidelity, who ran for many years a very successful investment fund called Fidelity Special Situations. There's also Bill Gross of PIMCO, a very famous bond fund manager, and more recently, Neil Woodford, formerly of Invesco, but latterly of Woodford Investment Management, to name a few. Just picking up on Woodford for a moment, with the benefit of hindsight, is it possible to see flaws in the investment analysis of certain pharmaceutical stocks? In essence, Woodford Investment Management was saying the market was wrong and that Woodford Investment Management's valuations were, shall we say, better than the markets. Alternatively, could it have simply been a bad case of confirmation bias? The Woodford investment analysts saw what they wanted to see in the research they were subject to. Whatever's true, it's certainly a salutary lesson that the market can be irrational for much longer than we can remain solvent. Undoubtedly, when there are so many investment funds available to us as investors, by definition, some of those will be above average. There will always be winners and losers. Research from the UK, which is supported from research around the world, suggests that the vast majority of fund managers are not simply unlucky, but are actually genuinely unskilled. Managers who do generate superior performance in excess of operating and trading costs then go on to extract the whole of this superior performance for themselves via fees, leaving nothing whatsoever for investors. Again, the research shows that in excess of 15 years of outperformance is necessary to genuinely discern real skill from luck. And it is impossible to make that judgment call in advance. This is also supported by Morningstar research, which has said time and again that the best predictor of a fund's relative future performance is low cost. And that reminds me of the other tenet that's worth remembering. One from Jack Bogle, I believe, who used to say, with investing, you get what you don't pay for. So today, I'm delighted to be joined by Robin Powell of The Evidence-Based Investor. Robin is an award-winning journalist and campaigner for positive change in global investing, advocating better investor education and greater transparency. Welcome, Robin.
Thank you very much, and to your colleagues at Expert for having me. It's a real privilege.
Great. Well, it's good to see you again. We have spoken several times in the past, and you've done some videos for us that are on our website about investing.
Yeah.
In years gone by. Robin, would it be okay just if we started out with a simple question, just for the benefit of our listeners today? Who is Robin Powell, and what is the evidence-based investor?
Okay, I'm a journalist, and very small world actually. I cut my teeth in journalism at a little newspaper called the Oxford Journal in Ensham, not a million miles from where you're sitting now.
Very close.
And from there moved on to various other illustrious media organisations in that part of the world. Fox FM, the Oxford Mail, and Central News South with Anne and Wesley, if you remember them. Yeah, was with ITV and Sky News for most of my television career. I'm now a freelance journalist, and I have my own production company. The Evidence-Based Investor is a blog which is not aimed at making shed loads of money. It doesn't make any money at all. It's purely, at the moment anyway, a pro bono project, but it's really just to educate investors, small and large, about how investing really works, as opposed to how the media and the fund industry likes to have us think it actually works.
Right, fantastic. So what sparked this this passion of yours to educate and inform investors that there is a better way to that which the industry perpetuates?
Okay, well, I thought I knew a lot about investing until about 8 years ago, and we were actually approached by a wealth management firm in Birmingham who had what I broadly describe as a sort of passive, low-cost, evidence-based investment philosophy. And they said, we want to get this message out there. So we made a documentary, and I went to the US and interviewed various people. You mentioned Jack Bogle there earlier, the founder of Vanguard. Various Nobel Prize-winning economists, financial thinkers, Eugene Farmer, William Sharp, some famous financial authors, Charlie Ellis, and so on. And to be honest, I was amazed, really, that there is all this evidence out there about how we should invest, and yet there's a whole industry here, aided and abetted by the financial media, that wants us to do the kind of very opposite of what we should be doing. And that, well, first of all, it shocked me, but it also annoyed me. It bothered me that actually that we have investors here, some wealthy, some frankly not so wealthy, who are frankly not being given their fair share of the proceeds of capitalism, simply because they aren't being taught about how investing really works. And that's how the blog came about, really.
Interesting. And you work with a number of financial advisors now, I believe, don't you, in terms of the the content marketing you do?
Yeah, so we produce video content, anything from sort of short micro videos to documentaries, online documentaries, of which we've made 3 now, major ones, and we make video series. We provide subscription content for financial advice firms, and yeah, we've got clients all over the world, not just Britain, but the US, Australasia, South Africa, and the Far East, and so on.
Fantastic, fantastic. And do you think the message of evidence-based investing, low cost, passive, do you think that's getting through to people now, or not?
I like to think it is. I mean, it's taken a long time. I mean, you know, Dom, that Jack Bogle launched his first index fund in 1975, which is by any stretch, is a long time ago. And it's was only really in the kind of early 2000s that the indexing started to become really sort of mainstream in the United States. It's now finally becoming mainstream here in the UK and in other countries. But frankly, there is much more room for growth, and I expect it to grow much more in the coming years. And I'll be honest, I get so frustrated still by frankly misleading reporting of fund management in the financial media, particularly around this whole issue that we're going to be talking about today, of star fund managers, which is from an educator's point of view, hugely frustrating. Yeah. So one final thought then before we kick off, which I think is hopefully going to be a nice segue. If it works, I don't know. We'll see how it goes. But I was reading the other day. I mean, you mentioned Jack Bogle, and famously founded Vanguard as low-cost passive investing. One of his phrases was very much, stop trying to find the needle in the haystack, just buy the haystack. But I was reading the other day that one of his children, his son, I believe, is actually an active fund manager, and works in the hedge fund industry. He is, yeah.
And when asked whether or not he had any money invested in with his son, he said, "Well, yes, of course I have, because it's family, and some things are bigger than your underlying beliefs," which I thought was really interesting.
Yeah, Jack. Yeah, absolutely. I mean, Jack Bogle, and I was privileged enough to interview the great man a couple of times, and he used to talk about what he called funny money. And he says everyone should be allowed 5% of their portfolio in funny money, what he called funny money. And indeed, he actually had some money in the Wellington Fund, which was one of the original Vanguard funds. He said it hadn't done particularly well. It hadn't done particularly badly either. I don't think it had done as well as his index funds. But he said he was happy for people to, if you like, speculate with a little bit of their portfolios, as long as they didn't go too far.
Yeah, reflecting.
I don't know what happened.
Reflecting, I guess, we're all human at the end of the day, aren't we? And
well, exactly.
We need to scratch.
Yeah, and if people want to have a bit of fun, if you like, with active investing, and I think that's one of the reasons, frankly, why people do it. They just fancy, having a little punt. Yeah, I was going to say, I'm not sure what went wrong with his son. You would have thought that a son of Bogle's would have been a 100% indexer, but never mind.
Yeah. So today we're going to talk about the myth of the star fund manager, and I think you've got someone particularly in mind that you're focusing on. Is that right? And shall I hand over to you now to crack on?
Okay, let's go for it. And I'm going to test my Zoom capabilities here by trying to share my screen with you. There we go. Okay, are we seeing that?
Yeah, I'm seeing that.
Great, excellent, lovely. The myth of star fund managers. And yeah, I'm going to talk about this issue in general, but I particularly want to focus later in the presentation on one particular fund manager here in the UK at the moment that everybody is talking about. And I know from what you've told me, Dom, that a number of your sort of clients and prospects have mentioned his name as well. So more on that later. But let's start with a question. and I'd like Harry at this point to run a little poll. And the question is this: how many funds over the long term outperform the market? When I say long term, I do mean a very long term, 20, 25, 30 years, that sort of period. But bear in mind, that's, you know, that's the minimum really that people are or should be investing for. How many beat the market on a cost and risk adjusted basis? So in other words, once you take out the sort of fees and charges and take those into consideration, how many funds have actually beaten the market? And by risk adjusted, you know, we would expect certain funds that take more risk than others over the long term to produce a higher return. But let's just adjust for risk, assuming that you know, all these funds are on a kind of level playing field as far as risk is concerned. How many funds outperform? Is it 45% of funds, 30%, 10%, 5%, or just 1% of funds that outperform over the long term? So let's have a look at what people say about that. Okay, so are people voting here? Dom, can you see any votes yet?
You have to ask Harry that one. I don't know. I can't see. Okay,
so can you give us the score, Harry? Oh, right. Okay, right. We've got 50% for 5% and 50 for 1%. I'll just give you just a couple more moments to vote if you want to. Well, okay, I'm going to put you out of your misery. The answer is that around 1%. Some studies put it at between 1 and 2%. Some studies put it at below a 1%, but somewhere around 1% of funds outperform the market over the very long term, which clearly is a very small percentage. So where is the evidence for this? Well, okay, let's have a look. Well, it comes from a number of sources. One source is the so-called SPIVA data provided by S&P Dow Jones indices. Morningstar have more recently started their own scorecard, if you like, of active management. It's called the Morningstar's Active Passive Barometer. And broadly speaking, you know, SPIVA and the Active Passive Barometer, they more or less say the same thing, that over the long term, it becomes harder and harder really for funds to outperform the market after costs. And also, we have academic evidence. I mean, here's one particular study which I'd refer you to. You'll find it on my blog, The Evidence-Based Investor. New evidence on mutual fund performance, a comparison of alternative bootstrap methods. It's by a team headed by David Blake at the Pensions Institute in London. And actually, David Blake says that once you include costs, actually the figure is much closer to 0% of fund managers who actually add value for investors. As Don was saying, you know, the managers take the profits of what they're doing effectively for themselves by way of fees and charges. So then, you might be wondering, you know, why this myth persists when there is this evidence from SPIVA, Morningstar, and countless studies over the years. And well, I would say that there are three main reasons. And the first is commercial self-interest. Here we have a very, very powerful industry. You could, in fact, say the most powerful industry in the world. It's the asset management industry. It manages assets of trillions of pounds, and it is very keen, obviously, to keep the status quo. It does very nicely. Thank you very much. There was a study by the Financial Conduct Authority here in the UK, which showed that typical profit figures, profit margins for asset managers are about 35, 36%. Any company would bite your hand off for a profit margin of that kind of size. And clearly the industry wants to keep alive this idea that there are staff fund managers out there if you can find them, and that's one of the main reasons why this myth persists. And as a result of that, it spends huge amounts of money on advertising. We've all seen the adverts on the sides of taxis, buses, in train stations, and so on. Down in London the other day on the tube, and looking at all the adverts for fund managers, active fund managers on the tubes. There is also the financial media, and I'm a journalist myself, and I would like to think that most of my fellow journalists want the best thing for investors, and I think generally they do. There is, however, a conflict of interest between investment journalism and what is best for investors, and the reason for that is that you can't just tell your readers every week that what they really should be doing is ignoring all this noise about star managers and investing in low-cost index funds, and frankly not following the stock market and doing something more useful with your time. Clearly that's not a great way to sell newspapers or investment magazines. So as a result, there is still a lot of coverage of active fund management, and particularly staff fund managers in the financial media. And of course the other issue is just simple human nature. We want to think that there is somebody out there who can beat the market. Very often, I find actually the wealthier the clients, the harder they find it to understand this, because often they have got to where they are. They have built their wealth, if you like, through a combination of hard work and skill, and they cannot believe that same formula, if you like, doesn't apply to fund management. But it doesn't. It doesn't. It's counterintuitive, but actually, the more we try, the more we look for patterns in fund performance, the more we try to identify the next star fund manager, the more likely we are to underperform as an investor. There's lots of research on this subject. In fact, we ran a piece on the blog the other day about something called the streaking star effect, and it's in the Journal of Personality and Social Psychology, and it's basically about this idea that we identify with individual star performers in a way that we simply don't with teams. And the study quotes, for example, the idea of why sports fans, for example, in general, are happy for the likes of Roger Federer, Tiger Woods, or Usain Bolt, for them to keep on winning, if you like, in the same way that, and I hope I'm not causing any offence here, in the same way that we might not be quite so thrilled to see that Man United have won again, although they don't seem to be winning very much at the moment anyway. So maybe I have to change that to another team. But the idea is that we identify much more with individual performance. That's another of the theories as to why we like star fund managers so much. A question that I'm often asked, and when I post content on social media about evidence-based investing, people say, well, what about Warren Buffett? Now, Warren Buffett is probably the best known and most successful, if you like, active fund manager of modern times. He has had an extraordinary winning streak, if you like, and he's a cult hero for particularly financial professionals and active fund managers themselves. But it's easy to lose sight of exactly why Buffett has performed as well as he has. And I would maintain there are, I think, three simple reasons why that is. First of all, he invests for the very long term. He, doesn't chop and change. He chooses a company and he'll stick with it for the very long term. When markets fall, he never panicked. He never just ran for the hills. And he's seen, let's face it, he just turned 90 the other day. He's seen more bear markets than any of us probably on this seminar. So he didn't panic sell. And the third thing as well, if you actually analyze his returns, he actually invested very heavily in what's called value stocks. So in other words, companies which for one reason or another were trading for lower than their actual value, if you like. And it has actually been proven by academics, without going into great detail, but it has been proven by academics that over the long term, there is a value premium. Value stocks do actually deliver a premium higher than the broader market. And that is the third reason I would contend why Warren Buffett has been able to outperform during his career. But there is a but, and it's this: even Warren Buffett himself hasn't beaten the broader market, the S&P 500, which is the main stock index in the United States, hasn't beaten the market since the global financial crisis. In fact, he's underperformed it by some distance. And it's worth remembering that for many, many years now, Warren Buffett has been a very staunch advocate of index funds. And it's something we don't hear about very often, because, this is the message that possibly the media doesn't like to convey. But he has consistently, in his letters to his shareholders and at shareholder meetings, he has consistently said that ordinary investors, and in fact not just ordinary investors but large institutions as well, would be much better off if they simply invested in low-cost index funds. I mean, I could quote one of literally dozens of quotes, scores of quotes from Warren Buffett over the years, but here's one from the 96 shareholder letter: the best way to own common stocks is through index funds. So that's Warren Buffett. Now, as I can see Dom's cat making a surprise appearance there across the screen. Also, another manager that gets talked about when we discuss star fund managers, if you like, apart from Warren Buffett, is Terry Smith. Now, Terry Smith, I think most of us, I'm guessing, on the call will be familiar with Terry Smith. He launched his flagship fund, Fundsmith Equity, 10 years ago by any measure, he's been very successful. The fund has generated a return of around 420%, which is more than double the return of the MSCI World Index. Yeah, he's attracted a staggering £2.7 million in assets every day in that time. The fund is now 21.6 billion under management, and that has propelled Terry Smith up the Sunday Times rich list. Apparently his wealth is now estimated at about £300 million, which is not bad for the son of an East London lorry driver. And he spends most of his days now on the Indian Ocean island tax haven of Mauritius. So there's a lot of coverage of Terry Smith at the moment, particularly because of this 10-year anniversary. So the question is, should you invest in Fundsmith equity? Now, although I am obviously not, as you gather from what I've said, an advocate of active management, I wouldn't want to dissuade somebody from investing in a particular active manager if they really feel that they want to, and that manager has done enough, if you like, to convince them that they should. But what I would say is there are several factors which I think expert wealth management clients should bear in mind before handing over their hard-earned money for Terry Smith to manage. Reasons for caution, if you like. And the first point is a general one, and it's really just to remember that there are bound to be winners. You know, just by the law of averages, there's bound to be someone who, you know, eventually flips 10 heads in a row. There are so many funds out there. Believe it or not, there are now more funds than there are individual securities. That's a staggering amount of funds. And funds come and go all the time. They don't generally survive for very long. Investors, as we were discussing earlier, investing over 30, 40, 50, 60 years, some of young investors today will be investing for. But many funds don't last more than even 5 years. So there are bound to be winners. The second point I would note is that Terry Smith's fund track record is actually very short. And you might be surprised to hear me say that. 10 years you might think is a long time. And that's because we've been trained to think of 10 years as a long time in investing. But as Dom will tell you, it is actually a very short time in fund management. The problem with fund management is there is so much skill in the fund manager community. They have such excellent resources for getting the very latest information that it is very hard to tell whether the managers who slightly outperform the rest, if you like, whether they actually genuinely have skill or whether it's just simply down to random chance. There's one study, for example, which shows that you need 22 years of data to be 90% certain that a fund manager has genuine skill. And if you think now that Terry Smith is, I believe he's 67, so he's had a 10-year record. Another 12 years from now, he'll be 79. So when he's 79 in 2032, we will have an idea, if he has continued to outperform, that he is probably a star, a genuine star. But by that time, will he still be running a fund from his home in Mauritius? I doubt it, frankly, but 10 years is not, believe it or not, a very long time. The other point is another general one, but really important, and that is that past performance does not predict future performance. And the industry should know this. After all, there are disclaimers on the details for funds all the time, which say that you shouldn't read anything into past performance, and that it doesn't indicate anything to do with sort of future performance. But that's exactly what the fund industry does all the time. It's what the media does all the time. And advisors and investment consultants who pick funds, they're very big on recent past performance. If anything, the fact that a fund manager has strong recent past performance only makes it more likely that that manager will start reverting to the mean, to use the statistical expression that we use to describe fund performance. So his style has worked well for the last 8 years. He actually underperformed for the first 2 years. It's worked well for 8 years. Sooner or later, it's going to stop working. He's not cheap either. And research by Morningstar has shown that the single most accurate predictor of future performance is how much you pay to invest. So broadly speaking, the more you pay in fees and charges, the less you keep for yourself. And one of the reasons why Terry Smith has been so successful is that he tends to hold stocks for the long term, like Warren Buffett, which is a good thing. And one of the benefits of that is that it keeps his trading costs to a minimum. And when I say his trading costs, I mean the investor's trading costs, because the investor ultimately pays for everything. So his trading costs are low, but his ongoing management charges, either 1.05% or 0.95%, depending on how you invest, that is a steep charge. And you can invest in an index fund or an ETF for about 1/10 of the price. So we're not talking about just shaving a few basis points off here. We're actually talking about a comparable product, which may or may not end up outperforming Terry Smith over the next 10 years, which is about 1/10 of the cost. That is a huge price differential. For some, this isn't a huge issue, but for others it will be. And some investors feel that they should expect the same accountability and transparency from their fund managers as those managers expect from the companies that they invest in. And a common criticism of Fundsmith, which is Terry Smith's company, is that it fails to provide enough data for people to make a thorough analysis of his stock holdings. And also, instead of publishing full annual accounts online, the company only provides short form accounts. The final thing I would mention is that his fund is now by far and away the biggest retail fund open to UK investors. And you might think that's a good thing, and it gives you a certain sense of security that a lot of other people are invested in the fund. But actually, there's a lot of research to show that the larger a fund becomes, the harder it is for that manager to outperform. Again, without going into technical detail, the manager is not able to be as kind of nimble, if you like, as they were when the fund was smaller. So for all of those 6 reasons, I don't dissuade you from putting money into Fundsmith equity. I don't want people turning around in 10 years and saying, oh, that Robin Powell said on that webinar that I shouldn't invest, and look, he's only gone and done the same again for the next 10 years. He might, I don't know, but statistically the odds are against him, and for those 6 reasons I would caution against certainly putting too much of your portfolio into fundsmith funds. And the other thing to remember is that I think you should start worrying when people start referring to somebody as Britain's Warren Buffett. And we're starting to see this phrase being used about Terry Smith quite a lot lately. Because the last guy who we called Britain's Warren Buffett, and of course there's been a long line of Britain's Warren Buffetts over the years, and many of them have fallen from grace. Possibly the most famous one, of course, being this guy, Neil Woodford. Well, we all know, I think, what happened to Neil Woodford, but it's worth remembering what people were saying about him at the time. You know, the time that he set up, for example, Woodsmith Funds, he set out on his own. He was in the papers all the time, and frankly, most of the newspapers, most of the investment magazines were very positive about him. Britain's very own Warren Buffett, the best fund manager of his generation, the man who just can't stop making money. That's an appalling headline for the BBC to use, but these are the things that were said about Warren Buffett. And I would just urge you, if you're keen to invest in Terry Smith, just to think, we're saying very positive things about him at the moment, but 5-10 years from now, things can change actually quite quickly. And today's star, if you like, today's hero can easily be tomorrow's zero. I'm not saying it will happen with Terry Smith, but there's a possibility for various reasons. Woodford's performance was catastrophically bad, and I would very much hope that Terry Smith wouldn't get into anything like those kinds of difficulties. But it's very dangerous to assume that just because a fund manager has performed very well in the past, that he'll continue to do so in the future. I'm drawing to a close now, and I just really urge expert clients to remember that no one picks the winners in advance. I mean, we've all seen these recommended fund lists from the likes of Hargreaves Lansdown, and they're frankly as good as useless. It's quite easy to add funds to a list, take them off the list, keep changing the list to make the list look useful when it's not. There isn't anyone who can actually pick the winners in advance. And of course, the frustrating thing is there are lots of financial advice firms who claim to be able to do this. They give the impression that they have the secret sauce, that they, however they do it, they can, spot the winners in advance. They can spot the losers in advance as well and avoid those and get out of those funds as well. But they can't. And I have addressed this issue many times on the blog, asked why it is that, intelligent financial advisors continue to recommend actively managed funds. I don't want to say too much about this, but I would refer you to some research, which again, I published on my blog. It's called The Misguided Beliefs of Financial Advisors. It's actually a Canadian study, and researchers found that actually financial advisors who recommended active funds and chopping in and out of active funds actually did exactly the same with their own money, and they did just as badly, in fact, even worse with their own money. They traded too frequently, they chased returns, they preferred expensive funds, they didn't diversify enough. And all those factors have been shown time and again to lead to lower returns. And on average, the clients of the advisors analysed underperformed the market by around 3% a year. 3% a year That's a staggering margin. And remember, the market return, of course, index funds aren't free. You have to pay to invest in an index fund. But what you're effectively doing is you are locking in, if you like, the market return. Very, very few investors get anything like the market return. But if you are underperforming the market by 3% a year, and you're paying charges to the advisor for giving you that, what I would call bad advice, that is costing you hugely in compounded returns over the long term. Real financial advisors, finally, I would contend, don't believe in star fund managers. I'm talking about firms like Expert Wealth Management here. Instead, they focus on areas where they really can add value. What are those areas? Well, it's things like controlling costs. Like I said earlier, cost is the single most accurate predictor of future returns. It's things like behavioral coaching, because we do silly things with our money, particularly when markets are going haywire. And actually, if you can have an advisor who knows about behavioral finance, and most important, who understands you as a client and what your particular biases might be, that's really a really positive thing. Financial planning, helping clients identify what's really important to them in their lives and what they want to achieve, and helping them to achieve those goals. That's really, really valuable. Cash flow forecasting, and again, I'm aware this is something that Expert Wealth Management offer. This, time and again, clients say is something that is really, really valuable to them. What is not valuable are financial advisors saying they can beat the market, because they can't. They can't prove that they've done it in the past, and they should be avoided, frankly, like the plague. Well, thank you very much for listening. I hope you found that interesting, and I'm very happy, guys, to answer any questions that people might have. I will stop sharing that screen now.
I think we're back now.
Okay.
Thank you very much. That's very interesting, very informative. Really enjoyed that. Very much echoes our message to clients. That we don't follow the cult of the star fund manager at all at Expert. In fact, I'd go so far as to say we don't invest in any actively managed investment funds either. Although we do allow clients occasionally to maintain some funds that they've held for many years, and I would put that down to their sort of their fund money account, that they can if they want to do that, that's fine. But our portfolios are always intended to capture the market return for the risk that clients are prepared to take, less costs, of course. And it's all driven by the by the financial planning and the needs of the plan. So it's always the case of no portfolio without a plan, and that's, I think, is a very much a key part of our value add. As simple as it sounds, you need to invest for the right reasons and in the right way, to achieve the goals that we've helped you to identify and quantify and everything else.
Absolutely.
So have we got any questions, Harry, John? Have we got any questions come in before or during?
Robin, I've got a question. You touched on earlier about the media and the conflict of interest that the media have. I imagine a full-page advertisement in the Sunday Times money section can't be a cheap item. I think last time I looked, it was about £50,000 for a Sunday Times. So I imagine there's a huge conflict there between the advertising budget of a media and what they actually write in the paper. I.e., they can't be sat there all day long saying you shouldn't invest in star fund managers, when the star fund managers are the one wanting to spend the money in the advertising space.
Well, absolutely. I mean, there wouldn't be so many financial magazines. There wouldn't be pull-out sections in Sunday newspapers if they weren't paid for by fund managers. There would just be far fewer financial journalists. Frankly, you know, I do see a very important role for financial journalists as financial educators. I mean, I'm a financial journalist myself. But I do think we have far too many, what I would call investment journalists writing about investing, just as we have too many fund managers as well. So yes, advertising, it plays a really important part. You can't, from a journalist point of view, you can't bite the hand that feeds you, can you? But actually, what I would say, speaking as a journalist, what journalists need more than anything else are stories. You know, we have to fill the paper with something. You know, we have to fill Central News or, you know, the Oxford Journal or whatever it is with something. And if you think about it, passive investing is boring. I remember talking to Ken French about this. Ken French, people may know, is a long-time collaborator of Eugene Farmer, the Nobel Prize-winning financial professor. And he said, well, financial magazines, they're hardly going to have me on the front cover every week. And yeah, of course they're not. Passive investing is boring. With active management, there's always a story. There's always a usually photogenic, and isn't it funny how a lot of the best performing or the best fund managers, we're told to use, are also the best looking as well. Sorry, I'm a little bit cynical about that, but it's true. Yeah. So it's the combination of those two things. It's the advertising revenue, but it's also the stories that active management provides that passive investing doesn't. That's important.
Yeah, the other is more of an observation for me that that actually struck a chord with me, really, was the way you were saying how we love to identify with individuals. And my example of that is I love following Formula One, and of course Lewis Hamilton has achieved massive amount over the last few years. Yeah. And it's interesting how we identify with that individual as people. But it's really interesting, every time you listen to Lewis in interviews, he always reminds the public out there that actually there's only two lucky guys get to drive that car. And I think Mercedes in their aerodynamic team have got 100 people just working on aerodynamics, you know, and they've got 300 to 400 people in the factory working on trying to get that car on track. But we love to identify with that individual, don't we?
Yeah. I mean, that's a really good analogy, actually. I must say, when I started in journalism, I didn't know anything about motor racing, and I thought it was all about the driver. But of course, being based in Oxfordshire, you know, you saw all those teams, you know, Williams and Benetton and March and all those other, you know, Oxfordshire-based teams, and you realise that actually there was a far bigger picture than just what, you know, the guy who sits in a cockpit, basically. And yeah, we did this study, by the way. Let me just find, just for those of you who are interested in it, it's called Streaking Star Effect. It's in the Journal of Personality and Social Psychology. Yeah, if you can't actually read the actual study, it's also on my blog. We posted on it last week.
Sorry, I'm being attacked by my cat again. Sorry. we have a new rescue, and she's a bit attention seeking. One of the this is an observation from me, really, that one of the things with active investment management is that you know, some funds can be very style driven, can't they? Neil Woodford was a very famous value investor. And Anthony Bolton at Fidelity, I think he did very well out of he was into small cap, wasn't he, in a big way. Yeah. One of the difficulties with active management is, you know, if you go down this road, as an investor, you've got to be prepared for sustained periods of underperformance. And again, you know, I refer back to Woodford, that, you know, he was having a really bad time because value wasn't in vogue for the last few years, and you know, people couldn't stomach those periods of underperformance. They weren't patient enough to wait for that to turn around, and you know, this is one of the big issues, I think, with active management. When you get periods of underperformance, which you are going to get, if you want to hang your hat on active management, you've got to be prepared to do that. And for financial advisors, they're going to be under pressure from clients to generate, you know, financial advisors that use active funds are going to be under pressure from clients to do something. And so, you know, if a fund is able to turn itself around, if the way that fund invests then comes back into fashion, by that time the clients will have bailed out, because the advisor will have told the clients to bail out and go and do something else instead, because the strategy wasn't working. So, you know, often you see with active funds that the returns the fund is quoting is not the returns that the client is getting.
Investors receive.
And that's exactly right. A behavior gap thing, isn't it? You know, in terms
and of course, you know, and you can't blame Woodford for the fact that he was a, you know, value investor and value as you know, let's face it, been on an absolutely dreadful run for a long time, but what you have to remember is that actually you can still invest in these factors. Again, don't want to get too complicated. I'm sure you've explained this to your clients, but you can still invest in these and capture these valuable risk premia, we call them, like value, like small cap. But you can do it in a broadly passive way. You know, you don't need to pay for an active manager just because you think value or small cap is due for a good run. It is actually much more efficient and much cheaper, actually, to use a broadly passive fund to capture these risk premium.
Yeah, costs are insidious. You've got to keep costs down wherever you can. Definitely.
Yeah.
Have we got any other questions, guys? Nothing coming in? Okay, so shall we wrap up today then? We've been about an hour, so that's been really useful. So thank you very much again for your time and energy today, Robin. Very much appreciated. We will get a recording out, as I said at the very start, in about a week or so, to all clients through our website, and we look forward to seeing you again probably in December for our next event. And as I said at the very start, if you do have any suggestions for topics or speakers for next year, please do let us know. Drop me an email, dom@expertwealth.co.uk, and we'll see what we can do. So that's a wrap for today. Thank you again, Robin, and we look forward to seeing everyone again next time.
Cheers, guys. Thanks for having me.
Thanks a lot.